Joining us right now, legendary investor Ron Barron. Of course, the chairman and CEO of Barron Capital. Ron's longstanding support for Tesla is widely known. Remember, he bought shares of Tesla back at about $40 a share back in 2016 when he couldn't persuade any other managers to invest. Today, it is the top holding in the Barron Partners Retail Fund. It makes up more than 45% of the fund's weight. Ron, it's good to have you with us, and it's good to see you at a time that it seems like a pretty critical one for the markets. How are you doing?
Great. How are you doing? Welcome to my house at Sunrise. When I was just walking out, I was telling my housekeeper I was a little nervous. And she says, "You've been doing this for so long, so many years. How come you're nervous?" I'm always nervous every time I get on this show. And plus, today I was listening to you. And so you have Gates today and Jay Clayton today, and you had Lloyd Blankfein 2 days ago, and you had Larry Fink yesterday. This is a really serious program. What am I doing in this program? Anyway, thanks for inviting me.
You're in good company, and you're here for good reason, Ron. You've been navigating these markets and watching what happens for a long time. And I know that you have been a steady investor and one who says don't pay attention to the headlines. But the headlines these days are hard not to pay attention to. Do you still take that same investing strategy in place today, given how fast the news cycle is, given how much of a whipsaw you can see from time to time with some of the markets? How are you navigating that?
We're doing the same thing we've always done, just being a long-term investor. Could I stop for a second and just go back about our firm? So we have 170 employees, and we have a few more than we did this time last year. And we're all working at a distance, and we have been since March 13th. My wife has a calendar on her refrigerator, and she's just crossing off the X's ever since then. And I'm hoping we get back to the city in January. Will Danoff gave a good interview in Barron's, I guess a great interview in Barron's a couple of weeks ago, and he's my friend, and he was talking about how difficult it is when you're working at a distance and don't get to meet people direct and don't interact with the people with whom you work, and so you're missing a lot. But we have been positioned well. What we're making money on now is decisions and based on decisions that we made 5 or 6 or 7 years ago. So we're long-term investing. We haven't done anything different. This year happens to be an exceptional year for us. This is probably the best year we've ever had. When I was walking out, I was trying to figure a sports analogy. When I was younger, I could give you sports analogies. The only one I can remember now is Sandy Koufax. And he was 27-3 one year, and for the Dodgers, and Yogi Berra was asking how he perceived Koufax, and he said there must be a mistake in that record, 27-3. How is that possible? How could anyone win 3 games against him? And this year we've had that kind of result. When I looked in the New York Times this past weekend, there was when they talked about the stock market, and they talked about how funds are doing, they gave the top 10 funds in the third quarter. And Barron Partners Fund was number 1. It was up 47.2% in the quarter. And Barron Focused Growth Fund was number 2. And it was up 43 or 44% in the quarter. And both of those funds are up 70 or 80% for the year. And our fund of funds, which is a fund investing only in Barron mutual funds, that's up 32, 33 at the end of the quarter, and it's up 38, 39 right now. So we've had a career year.
But how much of that is because of Tesla? Because if you watch the ones, Tesla is such a huge part of your funds at this point, and that stock has had a pretty phenomenal year.
In those two stocks, in those two funds, it's a very important part. It represents, as you said, 35 or 40% of each of those funds. And that stock is up 10 times in the past 2 years or 3 years. We invested in it between 2014 and 2016. We invested $300 million, $320 million for 1,000,006 shares. At that time, it's now 8 million shares, 5-for-1 split. So it's $40 a share, as you said. And the stock's now 400 or 420. And when we invested, and I was on your program, I was talking about how I believe we would make 20 times our money over 10 or 15 years. And so far, in the first 4 or 5 years that we've owned it, the stock went up and down like a yo-yo, and that would be expected because what they were doing is they were building facilities, hiring people, coming up with design. It's a reasonable thing to bet against them. All these car companies, 50 of them have failed, and this guy somehow had made it through sheer willpower and raised capital. Now he has 50,000 employees, and he has factories he's building on I want to get to Tesla, too. I want to answer your news question. But Tesla's now building on 3 different continents, building in the United States, building in China, building in Germany. And you should expect more factories to be built continuously over the next 10 years.
Last year they did bigger and steadier. Well, it's certainly gotten bigger and steadier, but you mentioned the volatility. Do you think the stock has passed the days of volatility because it's gotten on steadier ground, or do you worry that some of the Robinhood investors and others who have been so attracted to what Tesla has to offer, if there's any sort of shakeout in the market, does that impact them, and would volatility come back?
Well, what we worry about are not stock prices. When we're an investor in a business, we worry about the business. And the short term, I can't have any clue about what's going to happen. I do think that it's now a $400 billion market cap. It was $40 billion when we started. I've said for a long time I thought it was going to be $1 to $2 trillion. With what developments have taken place recently, I think $2 trillion is the right number. So I think it's 5 times from here. Made 10 times in the past 2 or 3 years, but for 4 years before that, the stock didn't change, and the business grew tenfold. So the business went from $2.8 billion to $30 billion 10 times. The stock price didn't change. Now the stock price just caught up to where they were. Now I think that the business is going to go from 30 or 35 billion in sales, grow 50% a year. I think they're going to be doing 5 or 6 or 7 or $800 million in sales in 10 years on just the cars. And the batteries is another unbelievable business, which I'm very excited about. And I think that with that kind of valuation, with that kind of results, you're going to see a 5 times appreciation. I was thinking 3 to 5 times. So maybe 10 times so far, 3 to 5 times to come in the next 10 years. Two more doubles, maybe 3 more doubles in 10 years is what the expectation is. So we're very excited about that. I want to get to Battery Day about what happened there and why it's so interesting. But let me go back to news. So one of my friends, he owns cable television businesses. He did own cable television business. He sold them. And he was telling me, and he's been an investor with us for 5, 6, 7 years. And he was telling me a couple of weeks ago, he says, Ron, the news is so awful. You tripled my money in the past 5 or 6 years. I have a tax-free account. Shouldn't I sell everything and come back after the election? Shouldn't I do that? And so my first question was, so Jeffrey, what is it that you know about all this news, about the election, about China, about everything you read about in the paper every day? What different impact, understanding do you have of those news events than what everyone else has? Where's your advantage? And then if what happens is that if you're right and the market does go down and it goes down sharply, then what's going to happen, and you sell. And if the market goes down sharply, what's going to happen is you're going to say to me, I'm going to call you up and I'm going to say, Jeffrey, congratulations on getting it right. You should buy back now. And you're going to tell me, Ron, it is so scary, I can't possibly buy back. That's on one side. And the other side is if the stock market happens to go up a lot in the meantime, instead of going down as you expect, then what's going to happen is I'm going to say, you're really missing it. You should be an investor. He says, I missed it, and I'm not going to buy. So if you sell, you're not coming back. And your choice is when you do sell, what's going to happen is you're going to take that money and you're going to have it in cash. And what you know 100% for certain is that the value of your cash is going to fall every single year, just like it has in every democracy for thousands of years. So you're turning an investment that you have in these great growth businesses and that you know are going to increase steadily over time or grow fast over time into something that you're 100% certain is going to decrease 3 or 4% a year every year. And in 17 years, it'll be worth half as much as it is now. 17 more years, worth half as much as it is again. Of course, on the other hand, I am 77, so I don't know how many of these halves I have.
You got a long time you have to let to go. We do not have a lot of time left in this interview, though, Ron, and I want to get to your thoughts on the idea that COVID has really brought a lot of that growth forward. I know you look at all of these technology companies. I know you've also got things like Hyatt and Vail and how those stocks are impacted by COVID. What do you mean when you say the growth has been brought forward?
Businesses that invested in technology. Lloyd Blankfein was on a couple of days ago, and what he was talking about was how he worked at a public company and a private company, and they were both named Goldman Sachs. And when it was private, what they did is that this business, when you're working for a private company, they were making as much as they could all the time. They didn't care about smoothing earnings. When they were a public company, in order to get a higher valuation, you want your earnings to be relatively consistent. So he said that so that's the difference in the businesses. And what we do is we invest in companies that are continuously investing in themselves, penalizing the current results. And when they do that, the stock prices reflect that element of penalizing earnings, and as a result, they're less expensive than they would be. And so when companies ever announce that they're making these investments in the businesses to grow bigger, then what happens is that the stock prices go down, and that's when we have a chance to buy more. So we are always buying, but we're buying more when stock prices go, and we're always holding. And when COVID comes along, there's nothing really that's changed other than those businesses that we're going to be investing so that over a long time they would get these results of these investments. Then what happens is that the results of those investments, everyone social distances, they work at home, and they work from the cloud. And so all these businesses that were relying upon a technology backbone, those businesses are benefiting from COVID, and business and growth that was speculative about whether it's going to take place. It's taking place right now. So that's what I mean by moving forward.
So, Ron, though, hey, it's Andrew. Real quick, are you concerned at all, given the growth of those stocks, that it's still going to take some time for effectively those companies' earnings to grow into those prices? Meaning, to some degree, do you have any concern that those stocks are overinflated, or do you really believe that all this is just accelerated and that the valuations accurately reflect where they are today, or frankly, where they'll be even better yet 12 months from now?
Well, if you think something like Tesla is going to go from 30 or 35 billion in sales to 600 or 700 billion in sales in 10 years, so 20 times, is that overpriced right now? How many businesses that you think are like that? And then when you think about their business, they have, when they did this battery day, they described how the suppliers weren't keeping up with them. NVIDIA wasn't developing the chips fast enough, so therefore they had to develop their own chip. And the reason NVIDIA wasn't doing that was because they were supplying other car companies who didn't need the chips as rapidly as Tesla did. Volkswagen, by the way, is going to be very successful in autonomous cars. Most of these other guys, in electric cars, most of these other guys are having difficulty. So what I think about the opportunities that these businesses have are so enormous, and for most businesses, they're going to have to change models, and people want to invest in growth. They want to invest in business and growing. Will Danoff talked about how he wants to invest in companies that are going to triple in size in 5 years. Here's a company that they think is going to grow 20 times in 5 years. What's the right multiple? And then for that, you're not even including what's going to happen when they go to autonomous driving, what's going to happen when they go to ride sharing, what's going to happen when they have a battery that's more powerful than others. They take out the stop signs on the highway, use different materials, and therefore you get 500 miles for a charge. And where are the batteries going to come from? The batteries are the critical point that's allowing this, stopping the company from growing even faster, getting enough batteries. So they make the money, investments in research for chips. They make the money, they invest money for batteries because the battery companies aren't investing fast enough. By the way, I also, when I go to restaurants and we sit on terraces, people comment to me and they say, oh, there's the Tesla guy. Oh, there's the Tesla guy, because of you, the Tesla guy. And what I want to be known as ultimately is not just the Tesla guy, but also the SpaceX guy. And this is too early for me to really talk about it. It's a private company still, and the valuation on the company is now 43, 44 billion. And we're an investor in that, probably on 1% of the company. And And what I think in that one is, well, I'm thinking about Tesla. We made 10 times so far, 3 to 5 to come, so we'll make 30 to 50 overall. And in SpaceX, I think that has a chance to be just as large as Tesla. We'll see. But in the next couple of years, I'm going to be talking to you a lot more about SpaceX than I'm going to be able to do right now.
Hey, Ron, I think Andrew was also asking about some of the other stocks. You guys have 450 investments in your portfolio. That includes companies like Amazon, Shopify, Twilio, Peloton, Zoom. Are you thinking the same thing with all of those companies, or are there points where you worry that any of those stocks have gotten ahead of what you think the growth it should be and how long it'll take to catch up to the stock price?
It's very hard to come up with the exact valuation of businesses all the time. Markets are not efficient when companies are growing as fast as those businesses are. We have 17 funds, and of the 17 funds, 10 of them are 5-star by Morningstar, and 4 of them are 4-star. And we've had this is a record-breaking performance for us. As far as all those companies that you mentioned, they're owned by a lot of our funds. Not in the size that I own Tesla, of course, but across the board, we have investments. And those are businesses that they've changed how you operate. I mean, Peloton, you're working at a distance, exercising at a distance with a trainer who's distant from you and working in your room. And Zoom, you're having these Zoom calls. My God, the Zoom calls I'm on, my wife says to me, she says, Ronnie, what are you doing? You're staying near your desk all day long. How can you not move? And she's in the next, she has an office next to mine, and she says, what are you doing? And she says, you have to take more time. You have to rest more. So they're changing your life. Spotify is changing the way you hear music, and Shopify is allowing small businesses to operate and being their partner and enabling to do business where they couldn't before. And Amazon, this AWS is amazing. I'm sure sooner or later they're going to probably separate those businesses with regulatory requirements, but that doesn't sound to me like a negative. But we guys at our office, they're expert. We have 438 investments, not 450, 438. And okay. We have 40 analysts, but they know that. I don't know it. And so far, we talk about their businesses all the time, their opportunities. Could I say one more thing? Do I have time for that?
Can I just ask one? Real quickly, you said you think Amazon is going to be split up, that AWS will be split off and forced out by the regulators. You think that's the case, and you're okay with that as an investor?
I don't know that's the case. I just made that up this second. I just remembered how things happened before. I don't know. But I think that, if it did, those businesses, when they get broken apart, actually tend to do better than they were before. When you talk about opportunity, do I have time for this one point right now? I was writing about this in my quarterly letter. So in Temple, the High Holy Days this year, year 5781 it is, a Jewish New Year. And our rabbi, and I wrote about this in my quarterly letter, our rabbi was giving a quote, and he said, the elderly will walk safely in the street as a prophecy in the street, and children will play fully fed in the parks. And the rabbi was making the point, and he said, who said this? He said, Prophet Zechariah 2,500 years ago, when Jews were exiled from Jerusalem and living in Babylon, or Governor Cuomo? And he said, so you're thinking you're in Temple, it's not being Governor Cuomo, so it's Zechariah. And then he said that the Jews, when they were living in Babylon, they longed to go back to Jerusalem, just like I longed to go back to New York City, longed to go back to Jerusalem. And they longed to go back as it was. And he said, that's not the way people want it. This guy is horrified, our rabbi, and I shouldn't call him this guy, our rabbi was horrified that children, the reason he says the schools everywhere else were closed, they weren't closed in New York. Why is that? And then his point was that there's 30 million children who are food deprived, don't have enough food. And he says the only way they were getting food in New York City for those children was they were getting their food from schools. And then he said, and healthcare, kind of a healthcare system do we have here where it's so frail that we don't have, it's a just-in-time healthcare system. And so when I listen to him describe the circumstance, he says, this is what, when I listen to Biden, for example, this isn't meant to be a political support of Biden or anything. I'm not supporting anyone. I tell people. But he has build back better. And this is the same thing this prophet Zechariah was saying 2,500 years ago. Israel, when they went back, the Jews, when they went back to Jerusalem, they wanted something different than what they had before. They didn't want corruption. They wanted to take care of the needy. The same thing happens here. And so when we go back to New York, we don't want to go back to New York as it was. We want to go back to it with better education, better health care, better food security for people, better technology, a better infrastructure. So when I think about all the needs that we have in our country, in our cities, I mean, everyone's going back. Jerry Seinfeld says we're going back. Spike Lee says we're going back. I say we're going back. In fact, I'm so convinced of that. We had the 48th and 49th floors in General Motors building. We signed up, and we took the 47th floor also, which we haven't built out yet. But we're going back. Yeah. And when we go back, New York's going to be different than it was. It's going to be better than it was, and we're going to be providing these. And the services that we need, that's where there's opportunities. There's opportunities everywhere.
Opportunities everywhere. Let's hope both you and Zechariah are right. Ron, thank you very much for joining us this morning. It's good to see you.
Thanks for inviting me.